squeeze. I don't know if we're going to get that or not. But remember, this is Third Friday. A ton of options are expiring today. There's going to be a lot of price action moving. And again, a lot of speculation around Iran. So we had the report. We'll dig into that momentarily. GDP, I actually missed because I was too busy. 1.4%, not good either. So we're not having a good day statistically. The full year, the U.S. economy grew at a 2.2% pace, down from 2.8%. That's actually way off from some of the numbers that we were seeing about fourth quarter expectations. And there's a lot of focus in this PCE report about wildfires settlement in Maui. So here we go. Flash PMIs come out later, looking at what's going on the manufacturing side. Logan and Bostic speak today. I am interested in what Logan has to say. And the reason for that is because the Secure Overnight Funding Rate, the SOFR, which is the real market credit level that we have to be paying attention to, not the Fed funds rate, but when the SOFR is above the Fed funds rate, and it has been, that's stress in the financial system. That's where we start to see cash problems. We're seeing that obviously in the private credit space, but also with that news that Japan changed their accounting rules to enable effectively getting rid of mark-to-market on their insurance agencies when they look at the bonds that are being held. This is the same thing that we did back in March 2023. They're trying to stave off a Silicon Valley bank crisis type of event. And typically these types of policy changes are accommodative for the plumbing, but then you've got even more stress that is building. So we'll talk more about this. We're going to probably see some shifts in our momentum reading momentarily. I need to just pull that up real quick, and we'll go from there. All right, because we were at, we're flat right now. We're -1. All right, -1. We're cautious right now. The reason this figure has kind of dissipated a little bit in recent days is because the number of stocks that were really selling off, and I'm talking about those companies like KKR, MSCI, Ares, NASDAQ.com, or NASDAQ. NASDAQ got a big insider bid from one of its directors. So these stocks have basically stopped breaking down in the traditional ways that we analyze them from a weekly perspective. So our selling pressure is dissipating, but the buying pressure really isn't there either. So we were expecting some possibilities of some squeezes. This is a very good day to keep a focus on volume weighted average price, particularly if we get into oversold territory. And we'll be focusing on expected moves on a lot of names like FactSet, Ares, Zimmer Biomet, and Westinghouse. We'll dig into that momentarily. This really is the big headline at the end of the day. If we're basing the GDP number on a shutdown, that's a problem, because GDP should not be run by government. It should be run by private sector, which is 70% of the economy. But remember, we are coming out of a long period where government spending pushed up into the 40s, if not higher at one point during COVID. So here's the core point. Hedge funds are still net selling. And all this is happening on the backdrop of Trump changing his mind again. So Wall Street Journal had come out, Axios had come out this week suggesting that real intensive operations were on the table. The Wall Street Journal is now framing this as a limited strike, which is less scary for markets. But in the backdrop, the UK government has effectively said that we can't use a base that was effectively co-managed in the middle of the Indian Ocean to conduct strikes. That's all over a dispute of England's desire to hand back land to Mauritius. I can't even pronounce that country. The point is, it's a geopolitical story that is mixed in with this framing of, okay, let's see if we can push Iran back to the table. If there is a targeted strike, oil will spike and then likely pull back. We've already seen that happen in the past when we saw the hits on the nuclear facilities. if it escalates, all bets are off. And you're talking 10, 15, possibly $20. And the threat that Iran would send more control into the choke points of the Strait of Hormuz, which is where the bulk of global oil shipping goes through. It is one of the major bottlenecks, if not the biggest bottleneck, in all of the energy sectors. It is the largest bottleneck. So we got the GDP number. I was less focused on that. I am focused on this PCE number. And once again, I put all this stuff together at 6:30 in the morning. I can't change in the last 15 minutes. We load everything up. So until we grow additional hands and brains, we just have to pivot from it. Core PCE up to 0.4%. That's the number the Fed watches more closely. Year over year up to 3, moving further away from the 2% target. This kills any short-term rate cut expectations. Now, we weren't expecting anything anyway in March. The question now is, does this take away from June? And I have been saying I don't expect an interest rate cut until Powell would be gone. But now there's the possibility that even if he is gone, there's not a lot of ability to maneuver in this environment. In addition, cutting at the same time that Japan is hiking, well, that creates a whole other set of headaches. We have to look out to September now. That's key. The real disposable income in this reading was 0.1%, while the saving rate fell to 3.6%, which is very thin. So the only reason nominal spending looks decent is because prices went up. That's not good. People didn't buy more things. Prices went up. So real good spending actually contracted by about 0.5%. That's the consumer. That's the consumer running thin right now. So that's going to be an important thing to be watching today, is the impact of this on consumer cyclical names. And this can be a pretty significant warning sign that something bigger is occurring. At the same time, remember, the consumer saving number is going down or struggling at the exact same time that there's problems in the banking sector with reserves. I'm going to look at this especially at the cruise lines, right? Cruise stocks have been actually really strong this year. Shockingly strong. I would have expected even more momentum to the downside. Here is your move coming out of November. But the breakdown continues. And if the consumer is tapped out, I don't know who's going on cruises. So CCL, these are names that on a day like today, you bring it down to your 1 day volume weighted average price, and there's going to be some chop. There's going to be some overreaction. You could see some of these names move into the 3rd, if not 4th standard deviation. And then because of the way that algos operate, this could squeeze. Now, we're going to wait to see what the market opens. I would expect these deviation bands to widen during the day. Keep an eye on consumer cyclicals today. If you strip out inflation, the consumer is barely treading water. And why does that matter? Well, it matters because income was flatter than expected. Income was flattened by a one-time $23 billion Maui fire settlement through transfer receipts. The picture looks worse without it. And we go back to some of the things that Blake has told us, which is this is a stagflationary setup. Real growth weakening, rising prices in the same report. That is not a good possible combination for risk assets. And that's one of the reasons why we're seeing some reaction today in things like gold, things like silver, and other metals. So this is a big macro story. I don't know anybody who's going on a cruise. See, but you live with all the retirees and you live in the islands. Whatever, man. You go on that cruise. You go for it. All right. So, number 3, this is This is the story that matters, because this is the plumbing in the financial system, and there's a lot happening all at once on this slide. One, blew out. Basically saying, hey, we're going to halt redemptions. This is the center of the private credit issue. We have been warning about this for 6 months. So anyone out there going, oh, I'm a little concerned about private credit now, is basically doing the same thing that other people might have been doing in, say, I don't know, September of 2008, saying, hey, maybe we should look into the housing market. The crisis has always been originating in the private credit market. It's not regulated properly. And in addition to this, we haven't known what is in a lot of this stuff. And it has been cracking since our top in liquidity. Private equity is under a lot of pressure. And even as we watch companies like KKR try to defend, the executives at KKR, they're trying to defend their stock, it's still bleeding. It's still falling off. There was 50 million purchases from the CEOs. So again, we have seen Japan change their rules on mark-to-market, which we did back in 2023 with basically our bank lending program. And I just keep stressing, every time we do this, we change a new rule. We create a new facility. We create some new way to lend money. And at the end of the day, what's going to likely happen is they're just going to turn the damn money printer back on, and they're going to flood the zone with capital. And then what's going to happen is all these companies will take that capital and lever back up. And we'll be in the same situation in 18 months. We do this over and over again, and we don't shift the guardrails. And then we wonder, oh, how did we get here? We got here starting in 2008 when we started QE. Actually, we can go back to 1971. I don't care. But the point is, they're going to print, and then these guys are going to do the same thing all over again. And then we'll be at S&P 500, 9,000. The Fed's balance sheet will be at 10 trillion. And shorts will be saying, what the hell happened? Some people might call me bullish. Some people might call me bearish. I'm just pointing out how the plumbing in this stupid system works. Don't be shocked here. That said, Bank of America is buying into private credit, $25 billion. And Trump is pitching a housing ban on the big institutions. Anybody over 100, you can't buy more. This doesn't solve the housing problem at all. It's 2% of the market. It's a sign of, you're taking some demand out. It hurts Blackstone. But for the most part, the real problem in housing is zoning. And until that is resolved, I don't want to hear anything else. Gold's above 5,000, safe haven bid. The headlines are going to say this is about Iran fears and Fed uncertainty. I'm going to tell you it's because probably the markets are going to start to expect more monetary policy accommodation. We are in that area right now, that third level, right, where consumer defensives has been getting a lot of focus and a lot of bids. We've looked at the XLP. We've seen, some strength to start the year. But for the most part, it's going to end up being, before this all kind of goes a little haywire, it'll be the long duration. It'll be long duration. You're going to start to see a lot of focus now on bonds. You're going to start to focus more on some of these other opportunities that emerge. Eventually, this is going to go from gradually to suddenly. Could be consumer, could be private credit, could be something similar. And then we'll see what the Federal Reserve does. But once again, Bank of Japan's already made their changes. China's still printing, and we're still pumping $40 billion a month into a banking system that has shown significant stress. And if you're new to the show, we've been talking about this for 6 months, and it's Groundhog Day. Just saying. All right, so let's get a little bit optimistic because there's a lot of opportunity out here. There's a bull market somewhere, right? Key thing, right? The money is still operating heavily in the midstream. And I have said time and time again, There's always money here. One of the nice things about this market is this is actually a heavily policy-driven market. And what I mean by that is it's very predictable in the way that policy changes by some of the agencies and some of the members of this administration, they're pretty honest about what they're doing. Doesn't matter if you agree with policies or not, they're going to just tell you, we're going to do this. And your natural inclination should be, oh, maybe I should probably follow that. Chris Wright is the Department of Energy head, Secretary of Energy. He came from Liberty Energy, LBRT, which, by the way, just got another sizable insider purchase. Let me get all this stuff off of here. Sizable purchase. The stock's up 33%. Big insider buy. And he has said, we've got to increase oil production by 100% to prevent energy poverty in the world economy. He said that the transition to zero carbon emissions is impossible. Yeah, that's right. But the key thing here is the focus on natural gas. Right? Natural gas is the bridge fuel across the board. And Energy Transfer is the big player in transporting that energy. So this is not a trade, right? This is not a stock to go out and try to ride it like a traditional momentum stock would. This is a buy and hold type of equity. And what we do here, this is an MLP. And whether you're buying ET or a closed-end fund like EMO or anything that is in between, those MLPs, those ETFs, those closed-end funds kick off cash, and they do it on a quarterly basis, and they pay 7 to 10%. And what do you do with that? You take the dividend, particularly if you can put some of this stuff into a retirement account, and you could trade that cash. Long-term, these assets are said to appreciate their inflation protection, and they're growing. So ET, you could do that. You can also sell spreads on a name like Energy Transfer as well. That's where you're selling a put and buying a put under the level that you sold it at. And the reason that you do that is you may be able to generate a higher return on that put than you would from the actual ETF or that actual stock itself, Energy Transfer. You may generate 12 to 15% instead of 7.5%. And nicely, you don't have to deal with K1s in the process. All right, SLI. What do you do? Well, we have to add a couple of moving averages real quick, and I would prefer the exponential. So we focus on the exponential moving average, and in this case, there's a lot of stuff that we're going to start to talk about soon about the 5-day moving average. But for right now, our focus is going to be distinctly on the 8 and the 20. And the reason for that is we're just looking for the general, broader behavioral measurement of a lot of other traders out there who trade the 820 EMA. So we have a name like SLI, Standard Lithium. We have a situation where monetary expansion continuing. And we have a stock that's pulled back pretty dramatically, and opportunities exist here. So SLI, right? They're trading lower. They're under some pressure. There was a commodity sell-off. Here, you have the stock that just crossed over. That's the hourly. On the daily, waking up a little bit from 525 and looking for a bounce back and continuation of trend, which has been to the upside. We like that. We like LAC, Lithium Americas. Obviously, this story is not going away. I don't use 5-day VWAP. I use 1 day. I focus on 1 minute. But you can use the 5-minute for anchoring purposes, and we need to do a full hour on that. We did not have the capacity to do it yesterday because of time constraints. We'll go from there. All right, on top of that, just to be on top of things, we have RCAT and EMR. Right? So another names that have been popping up recently, Red Cat Holdings, just chopping around largely. But this becomes a VWAP name. There's been some pretty significant, shifts in the stock, and you see the $1.50 type move. These are the types of names you're looking for today. You're looking for stocks that have the possibility to give you $2 to $3 in volume weighted average price. And if that is the case, then you have the opportunities for reversions from one band to the next. We have to go back and add that stuff back in. But real quick for everybody in the back, if you don't have VWAP set up, let's show you how to do it real quick. All right. In your settings, VWAP, volume weighted average price. You got to do it 3 times, and we're going to do it quick. But when you click it 3 times, you're going to see it is setting your -2 and +2 standard deviations. You have to change 2 of these. The good news is they're right up front in your settings tab. The first will be -3 and 3. Change the color, keep it, I don't know, white's easiest to see. Then you got -2. That color is going to be pink. That drives me crazy. How about just a simple blue? And then out here, you need to change the last one to -1 and 1. Color, white's fine, because you're still going to be focusing on the candle colors, candle moves. There you go. And it pops up on your screen. You're going to be 1 minute. And you can see, right, some of these moves, some of these names, companies that are reporting, some of the stuff that's been beaten up, some of the stocks we've talked about this morning. You're going to be looking for opportunities, particularly down here, third deviation. You can do that with the SPY. Right? Yesterday, had a move on the SPX down to the 681 level. We reverted back to the volume weighted average price. It doesn't seem like a big move, but on a day with options expiring, it's significant. It's significant because if you buy at the money, these could be 40, 50, 100% moves if you time it right and you are paying close attention. So volume weighted average price, be aware, look alive. All right. There's your SPY heading into this morning. We had a move down. Watch this when we wake up, when we start today. 683 is going to be your key level to get going. All right, to the downside, CL, LEN, BAM. All right, so interestingly enough to see Lennar and a lot of housing stocks start to pop up on these lists. And the reason that is important is, well, if you're going to set policy that is going to impact housing in any capacity, market doesn't like that, right? So Lennar's been running lower and lower, and it's been kind of this period of, go back 5 days, we're up at 123, kind of moving negative channel. And the way to be focused on this is having volume weighted average price here on a day like today, Friday. If we hit this level and we roll back over, and remember, this is an institutional line. So institutions are buying or selling around this line. If we go back up to this level and we start to fade again, $3, $4 move on options expiring today is significant, particularly buying puts. So make sure that you are taking aim here. Don't try to short up here. Use volume weighted average price as your anchor to start a next move down. In addition to that, of course, we are paying close attention to BAM. This is the whole space, right? This is the whole private equity, KKR, BAM, anyone in the space. This is the thing. The thing about this is you have to think about what happened in 2008. After Lehman Brothers collapses, all of the other banks freeze up because they're all counterparties. They're all involved. Now, here's the thing about private equity. They're all circling around for the same money, same dollars. They're all involved in private credit, they're all impacted by the plumbing in the financial sector. So any weakness impacts everybody all at the same time. The thing about this, though, that I do want to point out is that if we look at the names that are in the most extreme world, it's Ares Management, BAM, KKR. These are the names that everybody knows. But once again, we're focusing on continued weakness and the possibility that if these things do squeeze today, right, if they squeeze today, it's going to come out of moves down here. Keep an eye on that third standard deviation line. You'll see selling, and then you'll see just some nice little runs back to where we started. This has happened pretty much the whole week. There's been selling, there's been squeezing, there's been selling. And the process of this is, remember, funds sell into these pops, and algos appear to be buying into the weakness, pulling the price up, pulls more people back in, funds dump. Lower highs, lower lows. And nobody is the better picture of this right now than KKR, which is now down from 170 at the height of the liquidity cycle. All right, let me do one more, and then we'll take some quick questions. We'll go from there. Watch list Riot. Again, this is going to be heavily crypto dependent. BTC. What are we seeing this morning in BTC? Probably more weakness. We're at 67 today. I think most of the leverage in the Bitcoin world has been sucked out. So, you've seen these predictions down to 45,000. That doesn't seem to be coming in the next week. If we got down there, there's something really wrong. But I think that if we get deeper into this cycle, 45 is definitely in the cards because we're on the backside of the liquidity cycle and we're kind of in that crypto winter lead up. The moment that QE comes out, Bitcoin becomes a buy because all that excess liquidity, all that excess capital doesn't flow into our food, doesn't flow into our energy. It flows into what can move the quickest and the fastest. And there's no friction when it comes to the Bitcoin space. That's my theory, and no one has proven me wrong. I am undefeated. All right, so is Don shorting Walmart? Well, that's for Don to answer. I will say that this report today was not good news for Walmart, right? Continued movement down, but the thing that I will say, and that's actually a really good point, it's not like Walmart is a very highly liquid equity, right? It's one of the top 10 stocks in the S&P 500, I believe. It's at least top 15. That said, don't be shocked to see some interesting moves on this name today. It is options expiration. It is third Friday. So you want to have these charts up. You want to be looking for some action on this. And again, $2 to $3 on options that expire today, particularly as you get past that 10 o'clock hour today, sets up for possibilities where the stock hits, 123. It moves into fourth standard deviation, and then it rips right back to 124.50. And then it starts to sell off again. But you got to be quick and you got to pay attention. If you're trying to short something down here in the fourth standard deviation, you're going to be statistically setting yourself up to get squeezed in the short term. Some quick questions if anybody's got anything. Gianni is sharing some charts. XLE is our top performer. XLB materials, XLI industrials, XLP. So this is a classic third part of the liquidity cycle. Speculation on materials and energy. We've talked about this. The Trump administration has been heavy on industrial policy. And again, XLB and XLE are driven by industrial policy as well. So as XLI moves higher, you have to buy materials to engage in that type of productivity. And then the XLP is, of course, our defensives on the downside. It's all momentum, and it's all financing. So the XLK and the XLC, that's huge. It's communications. It's where Meta lives. The XLY, moving lower. The XLF, ugh. Well, that's financials. That's the plumbing. And I remind you once again, when we get to the point where we actually have break the glass style QE, you're going to buy every single bank possible. You're going to buy every high beta equity possible. But right now, people are learning the hard way how liquidity cycles learn, and they're trying to will a lot of these tech companies, particularly unprofitable ones, back higher. We still have a liquidity wall heading right at us at the end of this year. 13% of GDP needs to be refinanced. Just saying. It's going to be a tough year for anybody who needs to refinance in an environment where inflation is still rising. What time frame do you use for VWAP? 1 minute. Go to the 1 day, 1 minute. And again, everything is in play today, but remember that the most liquid thing in the world to trade is going to be the SPY, right? You can use the SPX, you can use ES, you can use anything with this. The Qs, higher beta, possibly, but again, it all kind of comes down to implied volatility and the cost of options. Remember, people want to sell you calls today. There's a market for it. You're not stealing a QQQ 680, 602 call. You need to really focus on where the probability lies of that higher return that most people are seeking. Don't try to scout between these levels. You can buy at VWAP and look for it to continue to move higher, which is a good, simple, safe, conservative strategy because that line is right there telling you what to do. But I will remind you, I would prefer if the volume weighted average price, when you're buying into it, is ascending because it becomes your stop, which means if you buy here and you sell here, you at least pull 20 cents out of the market. If you buy here and you sell here, you're going to be tempted to let this thing continue to ride. And nothing good happens when you start breaking your own risk management rules. If you're down here, remember, 99.7% of moves supposed to be within these three bands. You get down to that 0.3%. That's where you're looking for algos to step in. That's where you're looking for bids. That's where you're looking for short covering. That's where you're looking to think like an algorithm. Okay. Spring training games start today. They put me on at 3 o'clock today. There's going to be a television on right there. The hockey game's going to be on. Just telling you. So if you want to watch hockey with me today, 3 o'clock, we're also going to talk about volume weighted average price and break down what is going on with VWAP and how to use anchored VWAP as well. I hope everybody has a great trading day. Don's coming up at 9:30. We have a full day today. And from what I saw last with the schedule, I think DJ Tony Ragu will be doing a session today sometime around 12:30. What's the number? Yeah, 1:30. 1:30 with Rasta Friday. All right, everybody, have a great trading day. We will catch up in a little bit. Any questions, support at TheoTrade.com. Put Garrett in the subject line. Have a great day.